What the hell happened in 1971? That's a very popular search term online, and the answers to this might surprise you. Okay, we need to go back into the year 1971, otherwise known also as the birth year of my mother, but that's a different topic for another day. Today, we want to focus specifically on the 15th of August, 1971, which is when Richard Nixon went into the White House, turned on the cameras and told his nation and essentially the whole world, hey, by the way, you know, this gold window we've been having of $35 per ounce, so a backing of US dollars to gold, I'm going to scratch that temporarily. It could actually be re-implemented. And we're going to need this to form a new economic superpower and plan. The ideas to do this were actually quite needed because the US was losing the Vietnam War badly. A couple of years later, ironically, they found out that they were losing all over the place and all the time, so it didn't really make sense to get rid of the gold standard as they knew it and that gold window, but you know, you're always clever in the long run. And the idea to then create fiat money. And fiat money is essentially a vehicle that still has a certain backing mechanism. It doesn't mean that all central banks, for example, like the Fed in the US or the ECB in Europe, do not have backing of their currencies. They have some in silver and gold and other commodities, sometimes also in other assets, but it's not a fixed peg, and that's very important. Fiat money was really the birthplace where you could immediately print money. There was no circumstances that would prevail the central banks from not actually doing it too quickly or too much or whatever it is. And the repercussions of it was, well, we can always counteract this by what Nixon did as well, a 90-day wage and price shock, for example, where it's prohibited to not increase prices or decrease prices, as well as a 10% tariff. Ironically, we see this now as well in the US on imports into the US. But in the long run, fiat money has proven to just be expanded exponentially. And you see this in a couple of different charts. The most interesting charts probably is the key interest rate charts by central banks worldwide. Pre-Nixon shock, you really had a time frame where interest rates were changing, but they were very controllable, let's call it. You did not have to worry about 1 year being with negative interest rates and then 4 or 5 years later you'll be up in 5% and have a massive change on the balance sheet of the central bank. You would always have that consistency and that safety, I would call it, because of the gold backing. Not having stable interest rates and, you know, sort of a central bank that's more conservative, I would say, leads then to also more speculative investments on the market front, which you did see in the end with more expansion on the monetary policy, so more money being printed. Then on the second step, you obviously see more people have money available. They need to invest because they need to outrun the ongoing inflation because of that money printing. And that's what inflation is at the end of the day, not the price, that the prices get more expensive. And then on the third leg of it, you have to have a mechanism that sort of gives a return back to the central bank because they can print the money and have people invested and therefore, you know, stabilize the currency. But they also need a mechanism to essentially earn back some of that labor cost that they lose due to inflation. So they create something that's called treasury bills, where you basically buy these bills, you get a yield for it, you strengthen the dollar this way. And instead of having gold as a backing, you kind of have this as a backing mechanism. However, this doesn't work once, you know, the interest in those bonds and in those yields is not there anymore, but people are eager to invest, and then suddenly another war or something breaks out and the whole house sort of comes crumbling down. Speaking of inflation, we also see this with the most famous example, the Campbell tomato soup can. It used to be super stable before Nixon took the dollar off the gold standard, and ever since, its price and its expansion in inflation essentially has also been increasing, but the main product has been staying the same. And this comes now into why it has a connection to Bitcoin. If the US were to re-implement that gold window, you would certainly see a lot of stabilization again. However, gold itself is also that blown up that at the end of the day, it would not have the same impact as before. So at the end of the day, the other alternative you need to have is an asset that's even scarcer than gold. Ideally, because we live in a digital age, obviously integrated into that age as well. And that's not easily duplicatable. Well, if that's all that it takes, then there is only actually Bitcoin that is probably a safe bet. We will need to see if that would ever be a talking point of actually using Bitcoin this way to peg a currency to it, or if people would then say, well, Bitcoin is also a currency, why not just use that instead? But I'm curious to know if you have ever heard of the Nixon Shock and the 1971 phenomenon. If so, let me know in the comment below and give me your thoughts. And if you've never heard of it and you find these videos helpful, make sure to subscribe to our YouTube channel, because I'm always publishing videos about these matters and, of course, obviously about Bitcoin as well.